You are about to make $1 million financial decision. Half the experts tell you to wait, while the other half say act now. You are essentially guessing. The national headlines will confidently declare that the housing market is softening. But then you try to buy a house in a desirable school district and end up losing out to 5 other bidders. If you try to negotiate a deal or time your purchase using broad aggregated data for the Greater Toronto Area, you are flying blind. The reality on the ground is that Southern Ontario real estate no longer moves in a single direction. Asking if the market is up or down is simply the wrong question. You have to ask which specific submarket, which property type, and which timing window. What we actually have is a tightly packed collection of micromarkets, each playing by its own distinct set of rules. It is tempting to rely on a quick news bite to plan your next move. But navigating this landscape requires looking past the noise and examining the raw, localized data. Every individual neighborhood is reacting to a continuous collision of interest rates, fluctuating bond yields, local employment strength, and immigration flows. A modest drop in borrowing costs does not lift all boats equally. It can trigger a buying frenzy in one postal code, while another continues to stagnate. Making the right move means mapping your specific capital, timeline, and goals directly to the correct pocket of the region. A lot of buyers watch the Bank of Canada, assuming those announcements control exactly what they will pay for a mortgage each month. In reality, the central bank's overnight rate, which held steady at 2.25% in April 2026, primarily dictates variable rate mortgages. But if you are locking in, 5-year fixed mortgages are priced off longer-term government bond yields. Those move daily, completely independent of whether the central bank announces a hold or a cut. Borrowing is split. The policy rate steers variable mortgages left. The bond market drives fixed rates right. Even with rates frozen, bond yields bounced between 3.1% and 3.3% in May, silently changing carrying costs. When yields dip, sidelined buyers rush back. If you wait strictly for a headline rate cut on the evening news to start your search, you have already missed the actual window when affordability improved. Beyond borrowing costs, provincial government policy alters the math faster than almost any other variable. Take Ontario's recent expanded HST rebate for new homes in 2026, which outlines up to $130,000 in total relief for eligible properties. That massive capital injection immediately shifts the financial math for pre-construction buyers and for developers trying to build missing middle housing. The trade-off is that while tax relief stimulates the future pipeline, it does absolutely nothing to solve the immediate resale shortages we are seeing today. Long-term construction pipelines and immediate market availability operate on entirely different clocks. Your buying strategy has to align with the timeline that actually affects your purchase. To see how these variables splinter the market, look at the concrete core of downtown compared to the outer suburbs. High-rise condos in Toronto rely heavily on investor capital and first-time buyers stretching to secure financing. Because these buyers run tight margins, comparing carrying costs directly against rental income, this specific segment is hypersensitive to borrowing costs. When financing gets expensive or sentiment weakens, condo inventory piles up, absorption slows down, and prices face sustained downward pressure. Drive 40 minutes outward to Milton, Burlington, or parts of Oakville, and the ecosystem flips. These suburban markets are fueled by move-up families. They are not looking for a quick rental yield. They need square footage, specific school boundaries, and long-term stability. Because end users are competing for a strictly limited number of single-family homes, these areas stay highly resilient. Families will aggressively bid on scarce inventory, regardless of minor rate fluctuations. This comparison matrix highlights the divide. You have highly rate-sensitive urban supply on one side and highly supply-constrained suburban demand on the other, two opposing risk profiles. This explains the paradox in the data. Aggregate reports look soft, yet local school districts remain fiercely competitive. Treating a downtown condo and a Milton detached home as part of the same economic trend is a strategic error. Your next step depends entirely on your specific profile in the market. If you are a first-time buyer, keep a close watch on bond yield trends to spot brief windows of affordability. Target middle-ground assets like townhomes that offer a livable balance between high-priced detached homes and volatile condos. If you are a move-up family looking to expand your footprint in the suburbs, your most critical metrics are local active listings and days on market in your specific target neighborhood. If you are an investor, you need to rigorously monitor local condo absorption rates and model your potential cash flow against 3 different future rate scenarios. This chart compares the financial risk approaches. A first-time buyer is focused on securing equity, while an investor is strictly managing the spread between carrying costs and rental yields. Your identity in the market dictates exactly which data points matter to your wallet. Stop reacting to generic market noise and broad regional averages. Securing the best outcome in 2026 requires disciplined, localized interpretation of how rates, jobs, and supply are interacting on the specific street you want to buy on. Connect with Team HomeX for an expert assessment of your target submarket and build a localized strategy for your next property.